What the investors want to see is unabated growth. You certainly can't hold a candle to a platform monopoly within 18 months of launching. It's just not possible. Buying the dip, horrible idea.
We have a Netflix down. We've been talking about on the show, oh man, so many times. We're not bullish on Netflix. We are skeptical of Netflix because Netflix is not a platform business, because Netflix doesn't have supply side network effects to create a barrier to other entrants like Disney Plus, Apple TV Plus, HBO Max, Amazon Prime Video, Paramount Plus. I don't know, which ones am I forgetting? Probably a couple at this point. Disney Plus is approaching 100 million subscribers. It came out within 18 months ago. When you have a platform dynamic with two-sided network effects with consumers and suppliers on one side, what that gives you is a winner-take-all dynamic, hence the name of the show. Netflix doesn't have that because all of that content sits on Netflix's balance sheet, right? They have to pay for it, create it themselves, or license it. There's no contributed model where you have millions of producers like YouTube, right? We've seen YouTube remain in a platform monopolistic position for a long time. We've seen Barry Diller at IAC. Barry Diller understands platforms better than just about anyone. He owns Expedia. He owns Angie's List, Home Advisor, Handy. He owns Match and Tinder. The guy knows a thing or two about platforms and network effects and winner-take-all dynamics. There's a reason why Vimeo pivoted away from trying to compete against YouTube. Vimeo is now a SaaS tool provider to content creators. They're actually doing really well, but you can't compete against that platform monopoly. You certainly can't hold a candle to a platform monopoly within 18 months of launching. It's just not possible. And that is because what you would need to do to successfully compete against YouTube is convince millions of content creators to move off of YouTube, or at the very least, publish in two different places. And that's a very uphill battle. That's the chicken and egg problem, right? How do you get demand to get more supply and vice versa? And how do you climb that pyramid? Very difficult thing to do, very expensive thing to do. That's why platforms enjoy the highest margins as compared to any other business model, including SaaS business model. That's why the platforms enjoy the highest valuation multiples as compared to any other business model. That is why now you see Netflix. Although when you look at Netflix's earnings that they just came out with, when you look at this, it actually looks pretty good, right? They actually beat on earnings in Q1. They beat on revenue. Look, all the other quarters, they missed on earnings. But their stock didn't nosedive. And why is that? Down to, roughly $500 a share from like $550. So losing 10% of value after coming out with earnings. Why that is because these tech companies, these stocks, they're growth stocks. And what the investors want to see is unabated growth. And that is what slowed in Netflix's earnings result, was their subscriber growth. That's what the investors are looking at for these high-tech growth stocks. That's why they're called growth stocks. You have value investors and you have growth investors. And when the growth slows, why did the growth slow? Because the market is more competitive. It is more saturated for Netflix, right? So they already had an uphill battle, but now you got a bunch of very well-funded, these are some of the biggest companies in the world, nipping at their heels. And you know what Netflix is? Netflix is a movie studio. They're not a platform. They're a movie studio with really good digital pipes for distribution. It's a linear business. Doesn't mean it's a bad business. It just means that it's overvalued. We called it. And now I think you're seeing it. I don't think it ends there. You got people here like Cathie Wood, who is still bullish and buying the dip. Horrible idea. Horrible idea. The growth isn't going to come back. There's no magic switch that Netflix can just push at this point. Actually, the competition is only going to heat up on Netflix. Disney at almost 100 million subscribers. HBO Max, over 40 million subscribers. Peacock from Comcast, over 30 million subscribers. They're only going to get more aggressive. They're only going to get more into their own groove. as they figure out how to embrace this new model. It is a new business model, but it's not a platform model. So yeah, I don't think Netflix is out of the woods. I would definitely not be buying the dip because I don't think it's a dip. I think this is the beginning of a more competitive environment. This is Netflix turning a leaf. And the last point I'll make on this is one of the, newsletters here talking about Netflix says, Hastings has shown real discipline by staying singularly focused on building Netflix's video streaming service. Another CEO might have been tempted to diversify into other forms of entertainment like podcasting or music, or to broaden its programming into new areas like sports. While that may not happen, it is conceivable Hastings might start to think about selling. This might be the right time for him to cash out. Sell to Apple. Great idea. I don't know who wrote this one, Martin Pierce. But look at this. Another CEO might have been tempted to diversify. That's the CEO's job, is to keep innovating. The reason why Netflix is in this position, it's not like this is a small little baby company that's going to get distracted by innovating or exploring new models or new categories of content. This is over $200 billion market cap company after taking a 10% haircut on their stock. This is a symptom of leadership not innovating, not going into new categories. You want to know who's going into new categories? Spotify is going into new categories. Why is Spotify going into new categories? For the same reason that Netflix just had 10% stock dip. Because there's no fragmentation of the supply, right? You can't build a marketplace, you can't build a dominant platform without fragmented supply. It just doesn't work that way. Premium kind of video movie content is not very fragmented. There's like 5 big movie studios. Netflix is now one of them. Where there is fragmented supply in music is not music, it's in podcasting, right? Podcasting super fragmented. Where have we seen Spotify investing, getting Joe Rogan, getting other big marquee podcasters? It's what we call a marquee strategy. You go secure, key producer side, supply side assets to draw more demand, right, to your offering. I think it's a very smart move for content platforms like a Spotify to actually try and become a platform, right? Spotify, not a platform with just music. Podcasting has a platform business model because you actually have producers and consumers, right? You actually have contributors that are contributing inventory, asset light. Spotify doesn't need to pay for that podcasting inventory. It's not a liability like their music business is. Now, it's not a huge part of Spotify's business today, but it can grow. And I think it's a great, very wise decision for Spotify to invest in that. Why has Netflix not done that? Why has Netflix not embraced what I would call more broadly user-generated content? That's what podcasting is. This show is user-generated content. This is a video podcast. Netflix and their leadership has failed to stay ahead of the curve. This was obvious. I've been talking about it for years, and I don't get paid like Reed Hastings gets paid. He should have seen this. Maybe he did see it. He probably saw it. He just didn't act. And that is a failure in leadership. Hi, I'm Alex. Thanks for watching the show. Make sure to hit that subscribe button, but even better, make sure to follow us on Odyssey, follow us on Rumble, and text us 203-646-5159. Text the word Monopoly. You'll be subscribed. You'll get updates about when we're going live, our latest videos, and we'll send you even a little goodie bag. And in the event that we all get banned from big tech, we'll still be connected.